Before we delve into the world of currency trading, let's start by watching a trader in action. Imagine this. A trader, let's call him John, sits in front of his computer, multiple screens displaying a range of charts, figures, and news updates. His eyes are focused, darting from screen to screen as he absorbs the information. He's analyzing the market, looking for the right opportunity. After a thorough analysis, John zeroes in on a currency pair, the USD-EUR. He's noticed a potential trend and decides to capitalize on it. He places his day trade, buying USD and selling EUR, anticipating the rise of the US dollar against the euro. Throughout the day, John monitors the market closely. He watches the news for any events that could affect his trade, keeps an eye on economic indicators, and constantly analyzes the market trends. It's a world of numbers, patterns, and predictions, where each decision can lead to profit or loss. As the market closes, John reviews his trade. Today was a good day. The USD did rise against the EUR, and John made a profit. But he knows not every day will be like this. Tomorrow is another day, another trade, and possibly a different outcome. This is a glimpse into the life of a currency trader. It's a dynamic, challenging, and potentially rewarding field. But it requires knowledge, strategy, and an understanding of the market dynamics. Now that you've seen a trader in action, let's dive deeper into the world of currency trading. Have you ever wondered how currency trading works and how traders make their decisions? Well, you're not alone. The world of currency trading, or Forex as it's also known, can seem daunting at first. But with the right knowledge, it can be a lucrative and exciting field to delve into. Currency trading is a global marketplace where nations buy and sell currencies. It's a fundamental element of global trade, allowing countries to conduct business beyond their borders. Picture it like a bustling marketplace, but instead of apples and oranges being traded, it's dollars, euros, yen, and a host of other currencies. Potential profits in currency trading can be substantial. Imagine buying a currency when it's low, waiting for its value to increase, and then selling it for a profit. That's the basic principle. But like any trading field, there are risks involved. Currency values can fluctuate rapidly due to a range of factors, from political events to economic reports. That's why it's crucial to have a firm grasp on the mechanics of currency trading and the strategies used by successful traders. This video is designed to guide you through the intricate world of currency pairs and trading strategies. We'll dissect the concept of currency pairs, which are a fundamental part of currency trading. You'll learn about the major, minor, and exotic pairs and the factors influencing their movements. In addition, we'll introduce you to various trading strategies. Whether it's day trading, swing trading, or trend following, we'll help you understand these approaches so you can choose the one that best suits your goals and risk tolerance. Remember, there's no one-size-fits-all strategy in currency trading. It's about finding the approach that aligns with your investment goals, your trading style, and your risk appetite. So buckle up as we dive deep into the world of currency pairs and trading strategies. It's a journey that promises to be both informative and engaging, equipping you with the knowledge you need to navigate the exciting world of currency trading. Currency trading at its core revolves around currency pairs. So, what exactly are currency pairs? Well, in the world of Forex trading, currencies are traded in pairs, not in isolation. That's because the value of one currency is always relative to another. Imagine a seesaw. On one end, you have one currency, and on the other, a second currency. Their relative values move up and down against each other, just like a seesaw. It's this constant fluctuation that traders aim to profit from. The first currency in a pair is known as the base currency, and it's always equal to 1. The second one is the quote currency, or counter currency, and it shows how much of that currency is needed to buy 1 unit of the base currency. For example, if we consider the EUR-USD pair, the euro is the base currency, and the US dollar is the quote currency. Now, there are 3 types of currency pairs to keep in mind: majors, minors, and exotics. Major currency pairs involve the most traded currencies globally and typically include the US dollar. They're known for their high liquidity and lower spreads. Next, we have minor pairs, also known as cross-currency pairs. These are currency pairs that don't involve the US dollar. They're less liquid than major pairs, but they still offer plenty of trading opportunities. Lastly, We have exotic pairs, which include one major currency and one currency from an emerging or smaller economy. These pairs are less liquid and have wider spreads, making them potentially riskier to trade but also potentially more rewarding. Now remember, each type of currency pair has its own dynamics, risks, and rewards. It's crucial to understand these differences to navigate the Forex market successfully. Now that we have a basic understanding of what currency pairs are, let's explore each type in more detail. First up, we have the major currency pairs. These are the titans of the currency world, the most frequently traded pairs on the foreign exchange market. They are called major for a reason, comprising a significant chunk of daily trading volume. The major currency pairs are characterized by their high liquidity. This liquidity refers to how easily these currencies can be bought or sold without causing any significant price movement. It's like a bustling marketplace with buyers and sellers at the ready, ensuring smooth transactions. Another hallmark of major currency pairs is their low spreads. The spread is the difference between the buy and the sell price. In simpler terms, it's like the commission your broker takes for facilitating the trade. Because major currency pairs are traded so frequently, their spreads are typically lower. That's a boon for traders, as lower spreads mean less cost per trade. Let's talk about some examples. Major currency pairs always involve the United States dollar, USD. This is because the USD is the world's primary reserve currency, involved in about 88% of all currency transactions. One of the most traded major currency pairs is the euro against the US dollar, denoted as EUR-USD. Another one is the US dollar against the Japanese yen, or USD-JPY. These pairs are so popular because they represent some of the world's largest and most influential economies. However, it's not all about the majors. There are other types of currency pairs that offer unique opportunities for traders. These include the minor and exotic pairs, which we'll delve into in the next scene. But before we move on, it's important to remember that while the major currency pairs offer many advantages, they also come with their own set of risks. It's crucial to understand these risks and to have a well-thought-out trading strategy in place. Major currency pairs are popular among traders, but there are also other types of pairs that offer unique opportunities. So stay tuned as we continue to navigate the fascinating world of currency trading. Beyond the majors, we find the minor and exotic currency pairs. These pairs might not be as well known as the majors, but they offer unique opportunities for currency traders with a taste for the road less traveled. Minor currency pairs, also known as crosses, don't involve the US dollar. They are formed from the three major non-USD currencies: the euro, the Japanese yen, and the British pound. Some of the most common minor pairs include the euro against the British pound, EUR-GBP, the euro against the Japanese yen, EUR-JPY, and the British pound against the Japanese yen, GBP-JPY. Then we have the exotics. These are currency pairs that involve one major currency and one currency from an emerging or smaller economy, like Mexico, Turkey, or South Africa. Examples of exotic pairs include the US dollar against the Mexican peso, USD-MXN, the euro against the Turkish lira, EUR-TRY, and the British pound against the South African rand, GBP-ZAR. Now, while minors and exotics may sound enticing, it's crucial to note that they come with their own set of challenges. These pairs usually have lower liquidity than the majors, meaning there are fewer buyers and sellers in the market. This can lead to higher spreads, which is the difference between the buying and selling prices. Higher spreads mean higher transaction costs, which can chip away at your potential profits. But it's not all doom and gloom. The very characteristics that make these pairs challenging also make them potentially rewarding. Their lower liquidity and higher spreads can lead to larger price swings, offering opportunities for higher profits if navigated correctly. However, this also means increased risk. So, tread carefully and always have a well-thought-out trading strategy in place. Understanding these different types of currency pairs can help you choose the pairs that best suit your trading strategy. So, whether you prefer the stability of the majors, the intrigue of the minors, or the volatility of the exotics, there's a currency pair out there for everyone. Currency pairs don't move randomly. They're influenced by a variety of factors. Let's dive into some of the key factors that can make the numbers dance on your trading screen. First up, we have economic indicators. These are statistical yardsticks used by traders to gauge the health and direction of an economy. They include things like gross domestic product, employment numbers, and inflation rates. For example, if a country's GDP is on the rise, its currency typically strengthens as investors gain confidence. Next, we have geopolitical events. These are the happenings around the world that can cause ripples or sometimes tidal waves in the currency markets. Elections, changes in government policy, and international conflicts can all create uncertainty, and uncertainty tends to move markets. For instance, if there's political instability in a country, investors might pull their money out, causing the currency to weaken. Then there's market sentiment. This is the overall attitude of investors towards a particular currency or the market as a whole. It's influenced by a myriad of factors, from economic data to world news. If traders are feeling bullish about a currency, they'll buy, and this demand can push the currency's value up. Conversely, if they're bearish, they'll sell, causing the currency's value to fall. Additionally, central bank actions play a crucial role. When central banks adjust interest rates or engage in what's known as quantitative easing, it can send shockwaves through the currency markets. Higher interest rates usually lead to a stronger currency as they attract foreign investors looking for better returns. Lastly, let's not forget about natural disasters. Events like earthquakes, floods, or hurricanes can have a dramatic impact on a country's economy and, in turn, its currency. So, as you can see, the currency market is a complex beast, influenced by everything from economic indicators to the mood of traders. By keeping an eye on these factors, you can anticipate potential movements in currency pairs. It's all about staying informed and being ready to react as the world turns. Armed with knowledge about currency pairs, you're ready to explore trading strategies. This is where the rubber meets the road, where theory meets practice, where decisions are made and profits are potentially reaped. Trading strategies are the guiding principles that shape your trading journey. They are the roadmaps that steer your investment decisions, and they're as unique as the traders who use them. They are essential because they provide structure and consistency, allowing you to navigate the financial markets with a sense of direction and purpose. But what exactly are trading strategies? Think of them as game plans that are based on meticulous analysis, careful planning, and disciplined execution. They are informed by a variety of factors, including market trends, economic indicators, and your own financial goals. There are several types of trading strategies, each with its own advantages and challenges. Day trading, for instance, involves making quick decisions and closing all positions within the day, making it perfect for those who thrive in fast-paced environments. Swing trading, on the other hand, spans several days or even weeks. It's about catching the swing in the price movements, aiming to capture a larger chunk of potential profits over a longer period. Then there's trend following, which is about identifying and riding the market's prevailing trend, whether it's going up or down. This strategy is ideal for those who prefer to go with the flow and are comfortable with long-term commitments. It's important to note that no strategy is inherently superior to the others. It all comes down to your individual circumstances, preferences, and risk tolerance. The best strategy is the one that aligns with your financial goals and fits your trading style. In conclusion, trading strategies are the compasses that help you navigate the complex world of currency trading. They provide the structure and guidance you need to make informed and consistent trading decisions. There are many trading strategies to choose from, and selecting the right one depends on your goals and risk tolerance. From day trading to swing trading and trend following, the world of trading strategies is diverse. Let's take a closer look. Day trading is a strategy where traders buy and sell multiple assets within a single trading day. It's all about quick decisions and capitalizing on small price movements. The upside? There's the potential for quick profits, and you don't have to worry about overnight market risks. But on the flip side, it can be stressful, requires constant attention, and there's no guarantee of daily profits. Now, let's swing over to swing trading. This strategy involves holding positions over several days to weeks, aiming to catch price swings during that period. It's less time-intensive than day trading and allows for larger price movements, potentially leading to bigger profits. However, it also means holding positions overnight, which can expose you to unexpected market changes. Last but not least, we have trend following. This strategy is all about riding the wave. Traders identify the market's direction, up or down, and trade in that direction until the trend changes. It's a strategy that can be successful over the long term and requires less hands-on time, but it requires a lot of patience and discipline, and you might have to weather some losses until the trend plays out. Each of these strategies has its own set of advantages and drawbacks. Day trading might suit you if you thrive on fast-paced decision-making, while swing trading could be a better fit if you prefer analyzing longer-term price patterns. And if you're patient and disciplined, trend following could be your game. Remember, there's no one-size-fits-all strategy in trading. It's about finding what works for you, taking into account your financial goals, how much risk you're willing to take on, and your personal trading style. Choosing a trading strategy is a crucial step in your trading journey. It should align with your goals, risk tolerance, and trading style. Currency trading is a complex yet rewarding endeavor. We've embarked on a journey together, demystifying the intricacies of currency pairs, whether they're major, minor, or exotic. It's important to remember that the movement of these pairs is influenced by a multitude of factors, from economic indicators to geopolitical events. We also dove into the world of trading strategies, exploring the unique characteristics of day trading, swing trading, and trend following. Remember, each strategy has its own merits and drawbacks, and the choice of which to adopt should align with your individual goals and risk tolerance. In the end, the world of currency trading is not a one-size-fits-all. It's a dynamic landscape where knowledge, strategy, and adaptability are the keys to success. So keep learning, keep strategizing, and keep adapting. With knowledge and strategy in your arsenal, you're well on your way to navigating the exciting world of currency trading.